Hey, welcome back, everybody. Good to be here on Super Thursday. That's what everyone's calling it today, right? Super Thursday, because there's so much going on today. It's almost hard to fathom everything that's happening. So we'll get right into it right now. First of all, um, the European Central Bank is out with its decision on interest rates. So that's where we'll begin. Here we are on the FX Street economic calendar, and you can see the ECB has stayed at zero, right? And, and negatively where it's been, so nothing has changed, which is exactly as expected. So what's the big deal? Well, so far, and this is something we talked about yesterday because Bloomberg said that this would happen, and the euro took a steep drop yesterday on word that this would happen. The European Central Bank dropped its bias toward easing. And how did they do that? They did that. They changed their official policy by omitting some language from their statement. So it's not about what they said, and it's what they didn't say. The ECB omitted the reference that interest rates could be lower than their present level. So there's absolutely no intention to lower interest rates any further. So you can see this is where Bloomberg reported it yesterday. And so they knocked rates down. They knocked the euro down yesterday, but it bounced back up. And then yet today the news hits and there's some volatility. But so far, we're kind of right back where we started. We're around 112.30 right now on the euro. So it's created some volatility, but it's not created a lot of sustained movement, right? So it's not about what they said, but it's about what they didn't say. They omitted some language. There's no bias toward easing. So the ECB just plain and simple language. There is no intention to cut rates any further. There's no intention to stimulate any further. After years of cutting rates and stimulation, there's no intention to do any more of that. This is the first step toward raising rates eventually. That doesn't mean they're going to raise rates anytime soon, but we know that the U.S. has already raised interest rates, and it's possible that other countries like Europe are next in line, but it's not going to happen anytime soon. It's not going to happen this year. It's probably not going to happen next year, but but they have removed all of their forward guidance regarding lowering interest rates or stimulus. Now, if I put you on the daily chart here, I'm going to show you something interesting. We've got Draghi coming up in 20 minutes, Mario Draghi. Mr. Draghi is the one who brings the real volatility. Look at this daily candle here. This is a Draghi speech. We started at 110. We shot down 200 pips to 108. And then we shot up 400 pips to 112. That's a Draghi speech. That's what we're getting today. I'm not saying we're going to be volatile like this today, but this was on this day. That day was March 10th, 2016. This was an ECB meeting, and that reaction was the reaction to a Draghi speech after an ECB meeting. Same thing happened on December 4th. Darn it. There's December 4th. December 3rd, 2015. It looks like we jumped down about 50 and then up about 400 pips. So Mario Draghi can really bring the volatility. And particularly on days like today, when it's an ECB meeting, and because why? Because everything that happened today was pretty much expected. Where do we get those expectations? We get those expectations from the speech. When is the speech going to happen? The speech is going to happen in 20 minutes. Okay, 19 minutes from now. So that's exactly what we're talking about. Okay? Okay. Okay, so, all right. So we've got Mario Draghi in 20 minutes. All right, and that's going to tell the tale. So I still think 111 is a good area for support. We saw support there back in May and early June. 111 looks like a good area for support. Resistance 115, I think we said yesterday, that still holds, this 115 area. So, but it's going to be quiet for the next 15 minutes, and then things are going to get crazy, most likely. He'll give a prepared speech. The prepared speech will be released in 15 minutes, and then there'll be a question and answer session. That's when things really get interesting because, nobody knows what questions will be asked. Nobody knows what answers will be given. Okay. Now, in addition to Mr. Draghi, we have James Comey, the head of the FBI, or the former head of the FBI, will be speaking in front of Congress today. So that'll be interesting. Because everybody's waiting to see if there's something in there in his testimony that might incriminate President Trump. And then after that, we have all day long, we have the Great Britain, we have our parliamentary elections ongoing as we speak. So there's just so much stuff happening today. All right. All right. And okay, so anyway, the parliamentary election, I think the polls close in about 9 hours from now. So Comey's testimony is in a couple of hours, and Draghi's speech is in about 15 minutes. So, I would imagine that most currency traders have battened down the hatches at this point. I closed out my dollar-yen trade, as we discussed yesterday, and it's a good thing, too, because it's moved up. And you would expect that. Here's why. I mean, like this has moved down so much, right? So ahead of all this risk, we know that the shorts have made a bunch of money, right? So even though we didn't make it to the third target, we know shorts have made a lot of money, and now shorts are covering because they want to get out of this ahead of the news. So even though the events haven't occurred yet, shorts are getting out of the trade because they know that this is coming, that these events are coming. So if you think about it, that's actually the short covering is a tradable event. You see that something has moved a long way, and you can see these events are coming on the horizon, then it's fairly predictable that you're going to see some short covering. Here you see it again, a long move down on dollar Swiss, couple of green candles on dollar Swiss. Why? Because short covering. What's short covering? The shorts have to get out of that trade to get flat because they don't want to give up their gains. They know there's all this event risk is coming. Why give up their gains? Why surrender the gains? No good reason to surrender those gains. So they cover, and that's exactly what's happening here. New Zealand US dollar. Now, I wouldn't be surprised. I'm kind of surprised that this hasn't sold off a little bit. If I'm long here, and if I've made a ton of money on this, and the longs have made a ton of money, nothing but green going up, I wouldn't be surprised to see a little bit of red, because if I made money long, I'm probably cashing in a little bit. Maybe New Zealand folks feel that they're not exposed to this risk since everything that's happening here has nothing to do with New Zealand. That could be part of it. But this thing just keeps chugging along. Just unbelievable, right? Incredible. So anyway, I think you're seeing a lot of this, though. A lot of, like in Euro's coming down a little bit. Longs made a lot of money in Euro. Euro came down a little bit. I think a lot of the big risk is yet to come, even for Euro, because the big risk is Draghi. So that's what short covering is all about, if you've made a lot of money short, you're gonna probably take something off the table. And even at long, if you've made a lot of money on the long side, you're probably going to take some money off the table because it just makes sense, right? Protect those gains, right? Keep those gains. If we're making money, we want to keep that money. And so it doesn't mean necessarily that you get out of the trade entirely, but you're probably going to get out of some of that trade. You're going to close some of it. Okay. Some of the other stuff that happened today, by the way, GDP came out pretty strong for Europe, a little bit higher than expected, both year over year and quarter over quarter. For the first quarter, GDP came out 0.6, looking for 0.5. And year over year came out 1.9, looking for 1.7. And also, whoops, back it up. Man, oh man, what the heck happened here? Hold on a second. Okay, there we go. Now, CPI in Switzerland, I don't think too many people are worried about, but inflation was a little bit higher than expected in Switzerland. Year over year, 0.5, looking for 0.3, and month over month, 0.2, looking for 0.1. Switzerland maintains that negative interest rate, central bank interest rate. And that's specifically, they're trying to keep money from flowing into the country. That is specifically the point of having a negative interest rate for Switzerland. In other words, you're trying to discourage money from coming in. Think about it, right? If you have a bank and you want people to put money in the bank, you're going to offer an attractive interest rate. If you have a bank and you don't want money to come into the bank, you're going to offer a very unattractive interest rate, perhaps a negative interest rate. That's exactly what's happening in Switzerland. Switzerland does not want money coming in from other countries. And so they're offering a negative interest rate. And that's been going on for about 2 years now. In addition to all the other events, we have jobless claims in 11 minutes in the U.S. Initial jobless claims looking for 240,000 jobs. And, that's pretty much the only thing that anyone's worried about in addition to the other three events. If you're trading Canadian dollar, you've got a speech from the Bank of Canada, Governor Polo's. But if you're not trading Canadian dollar, that's probably not of too much interest to you. And that's pretty much it. Okay, let's get back. Now, probably the most interesting chart out there right now has been the dollar's just been getting destroyed heading up to this. But even on the dollar, you're seeing some short covering. This has just been lower highs, lower lows, dollar getting hammered. But look at the last 2 days. They're buying dollars heading up to this Super Thursday event. Why? Because they don't want to be short. They don't want to be long. They just want to be out. They just want to be on the sidelines. They just don't want to get hurt. Okay, which makes the most sense. Okay. All right. As far as stocks are concerned, we'll take a look at stocks. We'll take a look at some futures. And what we'll do is we're going to get comments from Draghi coming up shortly, and we'll go through those. There's your breakout on the S&P 500. That blue line is an area of resistance. The price smashed through it, getting a little bit of a pullback. I think you could call that a flag here. I think you could say that it's a flag pattern. So there's your flagpole, there's your flag. This is probably going higher. Stocks are going higher because bonds are also going higher. There's your breakout on bonds. So bonds are going higher because, and there's your breakout out of a ascending triangle pattern. Pull back to, this is your resistance level. You've broken out of resistance. Let me just try this at TY equals 103XN. Will give you a better reading on this. Give you a better chart. There it is. Yeah, it's almost breaking through, but it could bounce here. This is resistance, resistance. This should act as support now. And it's interesting to me that the price of bonds is going up 1 week before a Fed meeting. This is almost a complete contradiction. It's like the market is saying one thing and the Fed is saying the other. In other words, the price of bonds, if the Fed is going to raise interest rates, and they've been talking about it incessantly, then the price of bonds should be falling. Instead, what's happening on your chart? It's rising. The market is saying that the Fed is wrong. The economy is slowing down, and the Fed shouldn't be talking about, I'm not saying the Fed should be cutting interest rates, but they should not be raising interest rates. And the Fed is way off track here. The Fed, for their part, they see, they look at the unemployment rate, which is now 4.3%, and they say, well, everybody has a job. The problem with that statistic is that it doesn't talk about the quality of the jobs. And I mean, that's a very low unemployment rate, but it doesn't talk about quality of jobs or income. And the Fed seems to believe that wages are going up, or they're not going up now, but they will go up later. So the Fed is always worried about something that they think they see down the road. And this has been going on for years, but it never seems to come. It's just very odd. Meanwhile, the market is saying the exact opposite. The market is saying the economy is slowing down, and the market is cutting interest rates. When you see this price moving up, the market is lowering interest rates. It doesn't make sense. They can't both be. I shouldn't say that doesn't make sense. What I should say is they both can't be right. One of them has to be wrong. I'll put my money on the market because the market consists of people who have to be right in order to make a living. Whereas the Fed does not consist of people who have to be right in order to make a living. Right? The market consists of people who have skin in the game. And so I believe this chart. So if they do raise rates, they might have to cut them later. I just think it would be hopefully they're paying attention to this chart, because this chart's contradicting everything that they're saying. Okay, this might be the most. And what is this chart? This chart's the 10-year U.S. Treasury. It's moving exact opposite direction of interest rates that the Fed wants interest rates to move. Okay, British pound. British pound seems to be getting stronger. Based on polling results. The polling results seem to favor the Conservative Party. If there's one thing we should have learned over the last year or so, do not trust polling results. Polling results are frequently wrong or misleading. So please, do not gamble on this event based on polling results, because it is a gamble. But you can see that we actually got fairly close to 130, and you see a lot of green candles here. Why? Because the polls have been moving away from Labor and toward the Conservatives. Now, that's just the perception of the market, that right now the market believes that conservative equals higher pound and Labor equals lower pound. But here, the interesting thing is that the market doesn't always believe that. It believes that's what it believes today. It does not always believe this. One of the most interesting things that I saw yesterday, and I believe this was a headline on one of the British newspapers yesterday, was this: that there would be no Brexit negotiations, that the UK is simply going to walk away from the table. And if that's the case, it's going to be a hard Brexit. But you know what? Good for them. Because we know that Europe is not going to negotiate in good faith with the UK. Europe needs the UK to fail, and they will negotiate with that aim of trying to get the UK to fail. So why bother negotiating if that's the goal? I think they're doing the right thing. It's scary. It's a bit frightening, right? But I think it's the right move. It's the right thing. It's the right thing for the UK to do, because otherwise you're negotiating with someone who isn't really negotiating in good faith. And since both sides realize this, then what's the point of negotiating? You might as well walk away. And I think that's exactly what's going to happen. I see Mr. Draghi is speaking now. He's sitting at his desk. So let's get ready. Here he comes. Here's Mario. And just waiting for the initial comments. Usually the initial comments are like sort of pre-prepared. I imagine he'll say something about um, the decision to move away from the easing bias. I'm sure he'll have something to say about that. If he doesn't, I'm sure it'll be a question during the Q&A session. Jobless claims 245, so pretty close. Draghi sees rates at present level well past the end of quantitative easing. So what does that tell us? Interest rates will not be rising for a long time. So remember, the ECB is still involved in quantitative easing. The process of wrapping up quantitative easing is still a long way off. And even after that is done, there will be no rate increase for a long time. So interest rates will stay at zero for maybe for years, is basically what he just said. Let's put this on a 5-minute to see if there's any reaction. Draghi sees the present level of interest rates well past the end of quantitative easing. Quantitative easing will run at 60 billion euros per month at least through December, so quantitative easing will not be reduced this year. Quantitative easing will run until the ECB sees a sustained inflation pickup. Okay, so now you're seeing it on the 5-minute. You're beginning to see some big spikes in the euro. So far, here's your takeaway. You're going to continue 60 billion per month in stimulus through the end of this year at least, and continue beyond the end of this year until he sees a sustained pickup in inflation. And even after the end of quantitative easing, rates will stay at zero for a long time. This is all pretty dovish in my opinion. He is upgrading the risk assessment. So he's saying things are less risky right now. He says risks are broadly balanced. If things get worse, he reserves the right to expand quantitative easing. In other words, right now it's 60 billion per month, but if he decides he wants to, he can make it more than 60 billion per month. So if things get worse. He believes that he sees solid growth. He sees better momentum in the economy, and it will expand at a faster pace than previous expected. So he's saying good things about the economy, and so basically here's what we've got. He's making positive comments about the economy, A, and B, he's basically saying that quantitative easing continues at least through the end of this year at its current pace. Rates probably will not go up for another 2 years. Very substantial degree of monetary accommodation still needed. So he's not ready to get rid of quantitative easing just yet. Okay, I think we'll wrap this up now. Just to put a bow on it, here's what he's said so far. And I'll track what he's saying, and then when we come back at the top of the hour, we'll put a bow on it. But here's what Mr. Draghi has said. QE continues at 60 billion per month through the end of the year, perhaps longer. Interest rates stay at zero until way past the end of QE. Economy is improving, but it's going to have to improve a lot more for him to get rid of quantitative easing and for him to raise interest rates. And that's it. Let's wrap it up on that, and I'll be back in 30 minutes, and we'll get to some charts. Okay, everybody, thank you so much for listening. I'll be back in 30 minutes. Thank you.